Welcome, or I should say welcome back. This being the second in an unknown and indeed unknowable number of Hedgeye webcasts on the bursting of what our unfailingly understated CEO Keith McCullough has dubbed the mother of all bubbles. As those of you who've watched part one of the series know all too well, I'm David Salem, Managing Director of Capital Allocation here at Hedgeye, and the lucky guy who gets to interact over the next hour or so with two of the world's foremost experts on banking and bank regulation, my Hedgeye colleague, Josh Steiner, and my longtime friend and mentor, Bob Bruner. I've learned lots from Bob and his scholarship over the years, including especially from the book, which I will now give a shameless plug, Bob, the book that Josh and I will be discussing with Bob today. This is the just published second edition of Bob's splendid account, co-authored with Sean Carr, of the Panic of 1907. By prior agreement with Bob, he's going to take the better part of 10 minutes or so up front to sketch the chief antecedents and elements of that panic, as well as its immediate aftermath, following which Josh and I are going to put a number of questions to Bob, most of which will focus on the germaneness and legends to be drawn from the Panic of '07 for where we are today. And given the number and complexity of topics we're going to discuss, I'm not going to take even a tiny sliver of our limited time with Bob to describe his background, or indeed Josh's, except to note that I'm one of literally thousands of people who've had the good fortune of being mentored by Bob or Josh or both. Bob in his capacity as a renowned teacher and scholar, and Josh in his capacity as a leading analyst of macroeconomics, banking, and other forms of commercial endeavor prone to crises and panics. So with that preface, Bob, over to you with our profuse thanks for taking the time to be with us today.
Oh, you're very welcome, David. Hello, everybody. It's an honor to be with you today. The Panic of 1907 warrants everyone's attention because it was a pivotal event in the history of markets and the U.S. economy, actually the global economy, not merely the economy, but also the political, geopolitical environment. It was judged to launch one of the 5 or 6 worst economic episodes in the history of the United States, according to Milton Friedman and Anna Schwartz. It led to the founding of the U.S. Federal Reserve System and arguably prompted an extended period of what economists call hysteresis, that is to say, underperformance compared to economic capacity. Something terrible went on, and the book tells the detailed story of how the crisis, where the crisis took root, how the crisis went, and then what the consequences were, what the impact of the crisis was in the longer run. The sketch of the events is as follows. The crisis took root in a 10-year boom, beginning in 1897 and ending in early 1907, late 1906. And this is a boom extraordinary in the history of the United States. It was a period of over 7% annual growth in industrial output. And this would be not unlike what an emerging economy in the past few decades would have done during its most buoyant period. For indeed, at the day from the Civil War to about 1914, the United States was the China of the global economy. It was a massive sump for capital. It demanded vast infusions of investment predominantly from Europe. And it grew at an extraordinarily rapid rate. The growth began after the Depression of the 1890s. The Depression more or less ended with the election of William McKinley as president in 1896. In any event, from the period 1897 to 1906, the U.S. economy boomed. And this is an important stage for me to mention because it's a regularity of financial crises, not only in the United States, but throughout the world, that they are preceded by a period of unusual expansion, economic expansion. And things happen during expansions that lay the groundwork for a crisis. We can talk some more about that during the hour, but suffice it to say, it was a mighty boom and it led to a mighty crisis. I would argue that the crisis itself began with the San Francisco earthquake of April 1906. The earthquake devastated much of the city. It triggered insurance claims. The insurance claims ran all the way to the East Coast and then to the money centers of Europe, London, Paris, Berlin. Insurance companies shipped gold to the United States. This was the day of the gold standard, and the gold in the United States flowed to San Francisco to rebuild the city. This triggered a liquidity crunch, a credit crunch in the developed economies of the world. The Bank of England, which was the hegemon in setting global monetary policy, raised its interest rates in an effort to reclaim gold reserves. In fact, we show in the book that the Bank of England suffered a dramatic decline in gold reserves as of October 1906, and this triggered some very, very defensive action on the part of the Bank of England. Bank of England refused to discount notes from intermediaries that would help to finance American commerce. The combination of rising rates and refusal of the Bank of England to honor notes on the U.S. Triggered a very sharp credit crisis in the U.S. This led to a mini crash in the U.S., in the New York stock market in March of 1907. By May of 1907, the U.S. was in recession, as judged today by the National Bureau of Economic Research. Over the summer of 1907, companies began to cut dividends, cut capital expenditures, lay people off. New York City had difficulty placing bonds. It couldn't roll over its debt. It had to resort to J.P. Morgan for a special appeal to raise the money. Morgan did raise the funds. The subway system of New York City entered bankruptcy, which scared everybody. But the ultimate trigger of the epicenter of the crisis was a failed speculation on the market by people I would call insurgents, people who entered the financial community of New York in an attempt to create a large financial conglomerate. They called it chain banking in the day, but as part of their efforts, they also held interests in copper companies, and one of the copper companies in particular was deemed by these insurgents to be the focus of bear speculators, of a bear speculation, and the insurgents therefore undertook a bear squeeze. They tried to squeeze the shorts who had taken a bearish position against United Copper Company. It turned out that when they called for the delivery of the shares, all the shares came in. The short sale position was very poorly documented at the time. The attempted bear corner was an utter failure, and this led to the collapse of two brokerage firms, and then depositors in financial institutions that were deemed to be related to these insurgents began to run on those banks. The New York clearinghouse stepped forward to rescue those failing banks, and in the process, they cashiered the insurgents out of the New York financial system. Unfortunately, the damage didn't stop there. The runs spread to the very large trust companies of New York. Trust companies in New York warrant special comment here, which is that they were insurgent institutions in their own right. They took deposits, they performed many of the functions of a bank, took deposits, made loans, served as trustees, which was their customary business. But the trust companies were not members of the New York clearinghouse and therefore could not prevail on the clearinghouse for assistance in case of runs. At this stage, J.P. Morgan, who was attending a church conference in Richmond, Virginia, is called back to New York City and urged by the partners of his firm to commence deliberations about what could be done to quell the crisis. Morgan arrives, charters a group of young auditors to run into the most threatened trust company, Knickerbocker, and do a quick evaluation to see if the company was worth saving. They came back, they said they couldn't tell, there wasn't enough time. But the company was about to run out of money, and J.P. Morgan, listening to the other bankers in the city, decided not to assist the Knickerbocker. This is a pivotal moment. The Knickerbocker failed. It had to close its doors, and fear spread rapidly throughout not only New York City, but it spread to other major money centers in the United States, and then to small country banks in agricultural regions, in the mining regions of the U.S. and elsewhere. This was a full-blown national banking panic. The next day, more trust companies show up at J.P. Morgan's mansion on Madison Avenue and 34th Street, and they ask for assistance. Morgan sends more teams of auditors to check out the books of those companies, and this time the auditors come back and they say, yes, these two large other trust companies are worth saving. So he begins to organize rescue pools of private money to assist these banks, lending cash to the banks in return for the pledge of securities by those banks, by those trust companies, excuse me. And the trust companies live to fight more days. Morgan has to renew the loans, extend more loans, but ultimately the trust companies survive. The New York Stock Exchange next appears on Morgan's doorstep and announces that with the paucity of brokers' loans on the market, the speculators on the stock exchange would soon begin to sell their shares in fire sales, which would cause the market to plummet. And Morgan, realizing that if the brokers defaulted on their loans to banks and trust companies, in fact, the conflagration would worsen dramatically. So Morgan rescues the New York Stock Exchange with a $25 million loan pooled by him and his associates of the other big banks in the city. The New York Stock Exchange comes back the next day, requests more loans, and he helps them again. This goes on. The U.S. Treasury begins to lend a hand. George Cortelyou, the Secretary of the Treasury, is called to New York by Morgan, and they strategize. Cortelyou decides to deliver $25 million in gold coin to the national banks on the assumption that the national banks would relend that money to other distressed institutions. He delivers more money to other big money centers around the U.S. Cortelyou is one of the major players here. And by early November, Morgan says, you know, what we really need to do is form a rescue pool for the trust companies funded by the trust companies. And he organizes a big meeting in his library at his home. And the trust companies dither and dither. He's actually been meeting with all of them or subsets of them for 2 weeks. They've reneged, they've promised to help, they've reneged again. Finally, he calls this big powwow and draws them into the large room in his library and locks the door. And they bargain and bargain until about 3 a.m. Some one of them has to leave and discovers the door is locked, and Morgan hands a document and says, here's the document, here's your institution's name, here's the amount of money I'd like you to chip into the rescue pool, and there's where you need to sign. And one by one, he goes around the room, and all of the trust company presidents commit to this rescue pool that holds, finally. It turns out that very same weekend, yet the crisis moves to a brokerage firm that is teetering, and the collapse of which would yet renew the crisis. Morgan devises a rescue for the brokerage firm, in which a principal asset of the firm consists of shares in a southern steel company named Tennessee Coal and Iron. And Morgan plots for U.S. Steel, of which he's a director, to buy Tennessee Coal and Iron at par value, giving bonds, gold bonds issued by U.S. Steel in return for those shares. The directors of U.S. Steel balk initially, but then they say, okay, we'll go ahead with the deal on condition that President Theodore Roosevelt will not sue us on antitrust grounds. Morgan sends emissaries to Roosevelt the next morning. Roosevelt hears the story. Roosevelt consents, and the emissaries call Morgan and the New York Stock Exchange, and cheers erupt on the exchange to enormous relief. This marks the actual start of decline of the panic. Panic conditions, stress conditions continue until January, late December, early January 1908. But the crisis continues. The dire spillovers of the crisis continue until June of 1908. Layoffs, bankruptcies spike, companies close, much distress in the country. The New York Stock Exchange does not recover its previous high until the fall of 1909. But Congress begins to move in to consider what happened and why did this crisis occur, and who's to blame and what should we do about it. I can get into the details of several important hearings. Suffice it to say that slowly but surely, Congress decides to consider developing and establishing a central bank in the United States, which has not been the case in the US, at least since 1836, when President Andrew Jackson refused to renew the charter of the Second Bank of the US. Absent a central bank, the US has experienced a number of crises. I count 11 banking crises between 1820 and 1913. And Congress decides to establish the Federal Reserve System in December of 1913. As my co-author Sean Carr and I argue in the book, this is arguably the high tide of the progressive era. Progressivism during the Wilson presidency delivered a number of pivotal changes. We argue that this is numero uno, both in terms of its immediate impact as well as its long-term impact on the U.S. I could go into much more detail than that, David, but let's pause there.
Yeah, that's terrific. Thank you, Bob. I'm going to let Josh have the first question. Over to you, Josh.
Great. Thanks, David. Thanks, Bob. So yeah, I've been reading through some of your work. I was intrigued by this idea of what you call information problems as one of the core elements of your framework of financial crises. I've got a little quote here from your blog, which is excellent. You wrote, information problems are central to an understanding of financial crises. Over time, innovation in financial institutions, markets, instruments, and processes breed growing complexity in the financial system. Complexity makes it difficult for decision makers to know what is going on. The resulting information asymmetries spawn problematic behavior arising from adverse selection and moral hazard. Information problems contribute to the over-optimism associated with buoyant business expansion and the tendency of debtors to over-lever and of lenders to ignore prudent credit standards. So I was kind of reading through that, and I was thinking that, it reminds me of a phrase that we use to describe sort of the cyclicality of lending, which is basically that the last crisis is never the next crisis. And that sort of owes to this idea that, banks obviously become consumed by recency bias. They tend to, avoid whatever got them into trouble last time around. And that, of course, sows the seeds for the next crisis. But what I thought was sort of intriguing about your idea was this idea that it's really innovation and new developments, and the fact that there's this inherent sort of lag between regulation and policy that enables regulators not to really understand the nature or totality of the risks that are unfolding. So I guess my question is, sort of in a broad sense, is that the case, that that's really sort of always a necessary ingredient, that you have to have an innovative element that sort of blinds, if you will, the regulatory framework from the risks that are setting in? And it's not uncommon that either credit events or liquidity crises precipitate these, what we think of as financial crises, but they do often tend to have some new sort of element to them, some new wrinkle, right? And often it is a rhyme of what we've seen historically, but they do tend to have their own sort of new idiosyncrasies. So I'd love to hear your sort of broader thoughts on that. And does that mean that we'll always have crises because we'll always be innovating and developing new ideas?
Thank you. That's an excellent set of questions there. I think financial innovation, is an element in virtually every financial crisis in U.S. and world history, though I would be careful to say that it is. I doubt that it is the crisis. There's a tendency toward Ludditism. Luddites were the people who smashed the looms in the early stage of the British Industrial Revolution because they didn't like what innovation was doing to their pastoral existence theretofore. But we don't want to encourage Luddism in financial markets today. On the other hand, I do think that, as Joseph Schumpeter said, the gale of creative destruction is always present, always blowing, and it's a matter of how to deal with that relentless change in markets and institutions and products and processes that is the challenge for everyone. Schumpeter was lauding the entrepreneur in his book, on capitalism, democracy, and socialism. But the important idea there is that because the financial markets, all markets really, but financial markets particularly, are so dynamic, all decision makers need to be on their toes and looking out for where trouble will break out. And I think that, much like generals being prepared to always win the previous war, the most recent war, regulators and senior bankers too often are always thinking in terms of mitigating the risks that appeared in the most recent previous crisis. And we want them We want them to be able to deal with those risks, but we also want them to anticipate the risks that are about to come up over the horizon at them or around the corner. And I think that's what the history of financial crises demonstrates, is a natural tendency of policymakers and leaders to discount the unknown.
Let me pick up on that, if I might, Bob and Josh. If you ask me to distill into a sentence that sort of the key teaching I took out of the book, Bob, it would be that financial systems are only as strong as their weakest links.
Yes.
And I want to sort of put a two-part question to you that focuses on 07 and today, which is, as you look back on the panic of 07, what were the weakest links in that system that really weren't regarded as integral to the system by the key movers and shakers at the time? Either they didn't think they were links or they didn't think they were weak. And then maybe more to the point for our audience today, same question about today. What do you view as the weakest links in today's financial system, whether they're regarded as such or not by investors and regulators?
Well, as a prologue, I will say that I believe that trouble in financial crises always breaks out in the shadows. That is to say, in the periphery of the financial system rather than in the center. The trouble can gravitate to the center, as we saw in 2008, but so we need to look to the periphery, to the shadow institutions, shadow financial institutions. In 1907, the shadow institutions were the trust companies in New York. They were lightly regulated. They were quite aggressive in their practices. They're growing at an astonishing rate. And the other source of weakness in the financial system in 1907 would be the small country banks. These are typically small, relatively less well capitalized institutions with very concentrated loan portfolios, unit banks with just one branch, so they couldn't be diversified across customers, et cetera. The U.S. had over 10,000 banks in the early 1900s. That number grew to doubled more over by 1929. But the key idea is that the weak links in that day were the insurgent trust companies and the smaller, relatively less well-established and vulnerable country banks. In 2008, we have a very different rogues gallery of vulnerable links. Surely the mortgage loan companies, Countrywide, Washington Mutual, money market funds, the competitors with the banks for deposits. Money market funds, one broke the buck explicitly, others teetered on the brink thereof. AIG was a shadow financial institution dealing in exotic financial instruments and the like. Today, just carrying that forward one bit, I would add those kinds of institutions to our list, but surely the digital financial institutions, cryptocurrency related we saw the crash. We've seen the dominoes beginning to fall in the crypto space a little under a year ago, and the pension funds in Britain had to be rescued by the Bank of England for the very same reason that the Silicon Valley Bank experienced its collapse earlier in March. Pension funds generally have to be on our radar screen, possibly even life insurance companies, because we know that the aftershock of the pandemic has greatly impaired commercial real estate, and pension funds and life insurance companies are major investors in commercial real estate. And finally, I'd add venture capital companies are a shadow financial industry that warrant our attention because of their behavior actually in the lead up to the failure of Silicon Valley Bank, but also during the epicenter of the crisis there. They encouraged their portfolio companies to deposit cash with SVB. And then as the fears of SVB's stability began to grow, they encouraged their portfolio companies to withdraw cash. So those would all be domestic worries. I would add that financial crises aren't only banking crises. They can be currency crises of nations. They can be national debt crises. And there, Turkey would have to be on the spotlight today, both currency as well as national debt, and in Sri Lanka. We would worry the extent to which the defaults of those countries or others could emanate into the center of the global financial system. But I think we'd have to say that we have a pretty extensive list of vulnerable links today, David.
Yeah, further reason to lose as much sleep as I've been losing these days. We've talked a lot about these factors. Josh, over to you for a follow-up question for Bob.
Yeah, I've got a question that's sort of almost a link between, I guess, the last two questions. So, this whole recent experience, one thing that struck me, and I think it took many people by surprise, was the speed with which SVB failed. There's sort of a funny story about how, I think it was on Monday or Tuesday, the CEO was sort of sharing comments. I forget the exact circumstances, but I think it was about like his favorite Peloton instructors. And then of course by Friday, the bank had been taken into receivership. So I guess the question is, do you think that the speed associated with bank failures has changed in the modern digital age? And does that potentially increase the risk of prospective crises and failures? And then I guess relatedly, is the speed of regulatory response something that too is accelerating? I think about how long it took the Fed and the Treasury to ultimately effectively respond to the GFC versus how quickly they responded to this dynamic with Silicon Valley. And I also, I wonder a little bit prospectively about like the looming introduction, and David's brought this up in the past as well, but the looming introduction of Fed Now, right? The Fed's sort of new set of sort of high speed, if you will, payment rails that will enable effectively instantaneous settlement that's going to be rolled out in a few months. So just your thoughts about the evolution of technology, the speed of it, and whether that sort of inherently amplifies the underlying volatility framework for these types of events.
This is an excellent observation. The speed has been increasing as we go from the older crises in financial history up to the present day. In 1907, of course, the main figures either dealt face-to-face or via telephone, which was as yet still a rather novel technology, communication technology. There were crises in the late and mid-19th century. They were accelerated a little bit by telegraphic communication. But ever since the advent of the internet and money funds transfer over digital space, we have seen very rapid and large movements of what I'd characterize as hot money. Hot money is always a concern in a crisis. I'm doing some research today on the crises of 1720, the so-called collapse of the so-called Mississippi bubble and South Sea bubble. And there was hot money there, but it took days for the money to move. Today, it takes seconds. And that complicates the reaction time, the deliberation time of regulators, as well as money managers, corporate leaders, and the like. What it requires, therefore, is a regulator who, upon perceiving the threat of crisis, can move quite rapidly. And I think we'd have to say the very relatively shorter response time of the U.S. Treasury and the Fed and the FDIC in March of this year, as compared with the slower response time in 2008, as compared with the slower yet response time in 1998 and before, it betrays the more fundamental trend of accelerating movements, of the role of accelerated hot money movements in global markets.
Bob, let me build on that, if I might. And I don't want to overstate the problem or the challenge here, but it's something that we talked about in part one of this series. I'll refer to it simply the two words stranded assets. And I think you and Josh know what I mean by that. If we think about banking and the business model, we're borrowing short and lending long. We're typically providing sort of unlimited liquidity to our depositors overnight, on demand, all the stuff you just talked about with Josh, the rapid speed with which money can be removed. We're doing that while at the same time, typically on the other side of the balance sheet, acquiring illiquid assets or incurring illiquidity. And I just wonder, when you take a giant step back and think about banking's future in this world of rapid technological innovation, is the business model essentially obsolete? Are we going to look back 10, 20, 30 years from now and whatever you think of fossil fuel stocks, and that's not, today is not the day to debate that, but there were many people pretty recently arguing those were going to be stranded assets, that they'd become truly obsolete. Again, leaving aside what's going to happen with fossil fuel stocks, what about banks and bank stocks?
Your phrase stranded assets immediately calls to mind the phenomenon we saw in Japan of zombie banks who were functionally insolvent, but for whom the Bank of Japan refused to declare insolvency and or to close and resolve. This led to the stranding of capital, in Japanese capital, in those banks, who would continue to do business, but didn't attempt to foreclose on the loans they held in insolvent debtors and the like. And from a national regulatory standpoint, declining to close up a bank is one way of preventing the spread of bankruptcy and the spillover from the financial sector into the real sector of the economy. But the fact is that creating a host of, shall we say, zombie institutions full of stranded assets is, in the long run, highly dysfunctional to the economy. We want capital to go where it can be put to best use. And this is, not a good thing for capital to be stranded on the balance sheets of banks, in companies that, frankly, are not competitive, are not yielding a fair rate of return to their owners, and really have no prospect.
I don't know anybody who's thought more deeply about the cost of capital for banks than my colleague Josh. So again, I'll turn it back to Josh to follow up.
Yeah, I guess maybe in a slightly different direction here. I think obviously the question arises, just comparing and contrasting the events of 115 or so years ago with today. When you sort of think about this environment and you think about the sort of setup in 1907, are there any sort of especially noteworthy parallels or differences that haven't already been discussed between today and then, and or other major crises? And then I guess related to that, I've been sort of wondering, just sort of thinking about, your framework, is there, in your mind, is there sort of a set of conditions that can enable us to conclude that a crisis is effectively in the rearview mirror, or is the state of financial systems just too dynamic and too complex to make that possible? Without the benefit of a significant amount of hindsight, that it's obviously the case the coast is clear, or there are just too many idiosyncrasies.
On the first part of your question, I would say there are a number of important regularities, attributes that appear in crises again and again and again. And I've hinted at a couple of those already. One is the propensity of a boom to become the incubator of a crisis. Not all. So the U.S. has had many economic expansions in its history, but not all of them have led to a financial crisis. What distinguishes the booms that incubate financial crises is extraordinary growth in credit, particularly, probably associated with a relaxation in regulatory oversight, probably associated with the influx of hot money from abroad, or certainly an influx of hot money out of depositors' savings accounts, but and a rise in market speculation. Charles Kindleberger, one of the historians of financial crises, has said that booms tend to create a demand for swindles. There's something about a boom that brings out the animal spirits, as John Maynard Keynes called them, but the desire to seize an outsized return for what one might believe is a small risk. So a boom tends to precede a crisis. Second, a crisis tends to be triggered by something real, a shock of some kind. Surely the earthquake in San Francisco in April 1906 would qualify, but you could look to pandemics, the effect in March of 2020. You could look at there have been wars that have triggered crises, plagues, if you go back far enough in history, et cetera. And what distinguishes, and again, we've had all kinds of shocks in global history, but the ones that really tend to trigger a crisis tend to occur in the midst of great strain in the financial system, strain brought on by the extraordinary boom, but also a shock that is unambiguous, that's large and costly and quite surprising. I would say that the second part of your question was
the second part of the question was really aimed at, is there a set of conditions that you think are typical enough that you could sort of look at them and conclude with any kind of decent probability that the crisis is effectively in the rearview mirror, or is that just not really the case, and there is no sort of universal set of conditions that sort of makes that possible? In other words, each crisis is its own idiosyncratic set of factors, and you don't really get to put the timestamp on the end of it until enough time has passed that it's clearly well in the rearview mirror.
Yeah, I think the big idea would be that a crisis is gone when confidence has returned. So you would look into markets for metrics of confidence, such as spreads on high yield loans, bid-ask spreads in various markets, the the Fed has some really interesting data on fails to deliver in the Treasuries markets, and those tend to balloon at times of great stress. You could look at exchange rates, obviously prices generally, when it appears that prices have returned to levels more consistent with fundamental estimates of value, et cetera. But surely trading volume would help. All of those would be indicators of a return to some confidence, but no, I can't think of one indicator that would serve to be a silver bullet, an absolutely surefire indication of a return of confidence. The federal government publishes measures of financial stability. Those tend to be either concurrent or lagging measures, so you can't really look out into the future from those, but those can help give an indication.
Bob, you just mentioned the Fed in answering Josh's good question, and I want to follow up with a question. I would apologize for blindsiding you with this question, which is admittedly gnarly, but I did send it to you in advance. So the question is, if you had the unilateral power to modify the Fed's, powers and assigned duties however you wished, what changes would you make and why?
That's a deep question. I think we are approaching a crossroad, David, in which we have a choice between either adopting a regulatory regime not unlike Great Britain, or the UK rather, or going in the other direction toward less intervention, which I don't think would be the way to go. I'm not a big fan of extensive intervention, but what we want, what every crisis requires, is a response that is speedy, flexible, and brings a lot of clout. So we need speed. So you can't have what we have is a balkanized regulatory establishment. The Fed, the FDIC, the FSLIC, the SEC. We could go on and on and on. We need a decision maker. We need somebody who can arrive at a plan of action rather quickly for all the reasons that we discussed a moment ago. The speed of movement of hot money at digital speed really doesn't afford much time for deliberation and slow assembly of collective action. But we worry about the granting of such powers to one institution that could deploy trillions of dollars, as it did in the crisis of 2020, without congressional oversight. So the large question is, how much democratic control, shall we say, are we willing to give up in return for crisis fighting that is speedy, flexible, and carries a great deal of clout? And by clout, I'm referring to Larry Summers, who referred to a shock and awe response during the Mexican peso crisis of 1994, or Henry Paulson, who said in 2008 he needed a big bazooka to persuade the doubters in the financial markets that the federal government would intervene successfully to quell the crisis, et cetera, et cetera. I don't dash into the recommendation of a consolidated, centralized super regulator that would assemble all the powers of what today are the balkanized regulators. I don't leap into that with glee. I'm enough of a small d Democrat to want the people to have some say in the matter.
Yeah, we do have a colleague who's done some really seminal work on major turnings, major rearrangements of all of those mechanics that you just alluded to. And I think Josh may have a question that's based on Neil's work. Go ahead, Josh.
Yeah, I don't know how familiar everybody is with this book written by Neil Howe and his colleague Bill Strauss, The Fourth Turning, but it's really this sort of generational framework about how sort of risk and perceptions sort of evolve along recurrent and predictable sort of generational timetables. So I guess by the time you reach every fourth generation, the sort of collective wisdom and memory of previous crises has largely sort of faded away, which of course destines that generation to repeat those same mistakes, usually in a new but equally impressive way. And so I guess my thought or question is, as you think about that type of framework, are there sort of overlays or parallels to the banking system, to financial crises and panics of the past that we could think about through that lens of the Fourth Turning framework? I don't know if that's something you've given thought to.
I've read The Fourth Turning, and it resonates with me. I can't speak to the research underlying the thesis of the generation, of the cycle of generations, but I do agree with Mark Twain, who is alleged to have said, history doesn't repeat itself, but it rhymes. It rhymes. And what we see in crises is are those regularities I referred to a few moments ago, but a tendency of each crisis to open up new economic as well as political as well as social orthodoxies. And I'm much influenced by the work of Thomas Kuhn, who wrote. He was a scientist a historian of science, and he wrote a book about paradigms and how they shift and how they have shifted over the centuries to explain the natural world, and how the rise of a paradigm reflects the advent of new research methodologies and new evidence. The paradigm becomes bolted in place. It guides all thinking for a while until, sure enough, new evidence surfaces that challenges the incumbent paradigm, and then there's great controversy for could be years or even decades, and gradually a new paradigm emerges to displace the old one. And that feels rather like Howe's cycle, but it also takes us to a place that's fundamentally new. I think of the long trajectory of financial crises in the United States as having been a search for the economic and regulatory orthodoxy that will work, that will finally give us a stable world, a stable economy that will free us from the ills of this market instability. But it's been a process over the centuries, not unlike 2 steps forward and 1 step back. And what we are seeing today and what we saw in 1907 is the rise of a new orthodoxy with flaws that were discovered, that are yet to be discovered in the current day, and that will gradually be tinkered with and improved upon, and then bang, there will be another source of instability that could not have been foreseen based on the models of previous crises, and this too will generate yet a new orthodoxy. Whether this amounts to a perfect cycle along Howe's lines, I can't say, but I do think that the orthodoxy that prevailed most famously in the late 19th century, advocated by Walter Bagehot, former editor of The Economist magazine. He wrote a book called Lombard Street, which was essentially a how to do it manual for central bankers. And he said, in a crisis, the central bank should lend freely against sound collateral and at a penalty rate. And what we've seen in the 140 years since Bagehot's book is a gradual shedding of lending at a penalty rate and a shedding of lending against sound collateral, and we're experimenting with how much free lending we can get away with before other bad things happen. And I think we're encountering in this crisis the consequences of very liberal lending by the central bank in the crisis that occurred in 2020.
Bob, let me jump in. We're almost out of time. We're nearing the end of the hour. I'm going to do another proud plug. It would be shameless if you did it, but I'll do it for the book. But I'm pointing back to the book because we began the hour with your good, succinct summary of what happened in 2007. And as I reflect on what you teach us in the book, in my own separate study of what happened, I'm really fascinated, if not obsessed, with the movements of two actors on the scene. Obviously, Pierpont Morgan, and then separately, somebody whose name hasn't come up previously in this conversation, and that would be Rockefeller Sr. And these days we're taught as professional investors, always do a pre-mortem. Let your imagination run wild before you write out the ticket. What could go wrong? And it struck me as I read through the second edition that Morgan didn't ask himself that question when he decided to let the Knickerbocker Trust go under. And then separately, before I turn it back to you to comment, Rockefeller in the book, you recount him saying that he was prepared to pledge half his wealth to make sure the financial system didn't collapse. So as I said to you offline, what was he going to do with the other half of his wealth if the system did collapse? So I would really welcome, as we close the hour, your reflections on Morgan's actions and Rockefeller's in the context that I just drew.
Well, both figures were controversial in their day. They were the focus of the growing group of investigative journalists. Ida Tarbell wrote a book about Standard Oil that prompted a great deal of governmental investigation and ultimately the antitrust breakup of Standard Oil. J.P. Morgan was similarly reviled by Robert La Follette and other progressives for having formed a money trust. But in reality, in the absence of a central bank, there was no alternative to rescuing financial institutions that were illiquid, but still solvent. They just didn't have the cash. They couldn't get the cash fast enough. They couldn't liquidate their assets rapidly enough to get the cash to meet the demands of their depositors. And that's where Morgan stepped in. Rockefeller was not as prominent a figure in the crisis, although he was undoubtedly influential in the shadows, because the two great nationally chartered banks of the day, the two largest, were City National Bank, which Rockefeller de facto controlled, and the other was First National Bank of New York. The two banks, by the way, merged, ultimately producing First National Citibank, in other words, which today is Citigroup. But Rockefeller instructed James Stillman, the president of City National Bank, to cooperate liberally with J.P. Morgan. Of course, Stillman and Morgan were well known to each other. They had collaborated on deals before. George F. Baker, who was the president and chairman of First National Bank of New York, was also very well known and a very close friend and associate of J.P. Morgan. So those three were the instrumental players in the financial sector in New York during the crisis, and arguably formed the core of rescue strategizing, but probably couldn't have been as successful if John D. Rockefeller had told James Stillman not to get involved and to harbor all the resources and, don't extend loans to these risky financial institutions. I don't know what John D. Rockefeller would have done with the other half of his money, but by that date he was so rich that he wasn't going to be hurting.
Yeah, thank you, Bob. We do need to let you go. I do want to thank Josh for his contributions, and Bob, you, of course. I'll note for the audience that when you published the first edition of this 16 years ago, I had the privilege of interviewing you about it in front of a live audience, a smaller audience than we have today virtually, but that was great fun. And I'm going to take the over on the bet of over and under whether you're going to publish a third edition 16 years from now. I'm sure you will, and I hope to have the privilege of interviewing you at that time. So, Bob, thank you so much for your time today. We really appreciate it. Yeah, and wish you all a very good day. Thanks for joining us.